Everyone is thinking with us versus herd. If it's your first time here, you like the content, hit subscribe. If you want to get notifications for when we go live or post a video, tap the bell. And if you want to join the UVH fam, links are below for our options trading group and our Discord below. But what I want to get into today is how Robinhood makes money. People ask a lot of times, hey, if Robinhood is offering everything free, how do they stay in business? How do they make money? And it kind of makes sense. You kind of wonder, if someone gives you something free, give you the platform for free, give you the trading platform, give you the web, mobile, blah blah blah. It kind of makes you wonder, where are they making money on the back end? Because up front, they're asking you for nothing. And Robinhood's been in the news. I mean, they're a private company, so it makes it a lot harder to track. They're going to probably have their IPO soon, but where do they make their money? How do they make their money? And if you go to Robinhood's little support center here, this is support.robinhood.com, and look, they actually have an article how Robinhood makes money, and there's only 3 areas basically: Robinhood Gold, interest from cash and stocks, and rebates and from market makers and trading venues. And you're like, well, that's pretty vague. That doesn't make a whole lot of sense to me, because I mean, that could be anything. I mean, what does that mean? And then I know that personally, Robinhood, people do think that they skim money off of orders, because like the quotes lag a little bit behind other brokers like Thinkorswim or E-Trade or Tastyworks or whatever the case is. People think that they're skimming. I have no way to prove that, but because they're so vague about everything, it does get people to question, like, okay, if they're asking for nothing, they must be making money in the back end here. And right here on how Robinhood makes money, they don't really tell you anything. You kind of have to dig a little bit. So for Robinhood Gold, obviously you're going to get paid. You're going to pay the $5 monthly fee, which you get access to margin and all that. But they also charge a 5% yearly interest on anything above $1,000 of margin. So actually it's not that bad. Comparing to other brokerages, it's actually a pretty good deal. And it's also 5% APR. It's not like 5% daily. So you multiply the 5% divided by 360. So if you made a $2,000 investment on margin, the 5% divided by 360 days. So 5% divided by 360 days, you're going to be paying for 28 cents a day on that margin. So that's, looking into it and looking at the things that Robinhood is doing from my perspective. I mean, you don't necessarily, I'm going to go through some of the controversial things here in a bit, but you don't necessarily see them like making a ton of money. It's like mostly like micro transactions and then giving you resources. So margin, it makes sense that they charge a percentage fee on margin, because they're putting risk on there and they need a return on their risk. Just like anything, any broker is going to ask you for that. And also any broker, the one thing that I don't know is if this is like a flat 5% or if it's like certain stocks they charge more, because on E-Trade, TD Ameritrade, Thinkorswim, and Tastyworks, they raise and lower margin requirements for certain things depending on how risky the stock is for them to do. Or they might say, hey, there's no margin on this at all. It depends on what the broker will allow you to do, especially if you're short something. So that's not so this is not so bad. Interest from customer cash stocks, much like bank collects interest on cash deposits. I mean, so basically, I think Robinhood sales pitch is they want to control the millennial. They don't. This is not their sales pitch, but this is what their goal is to do. Their sales pitch is, hey, come here for free. We make this worth your while for free, and what's happening though is they're wanting to control the millennials' money as much as possible, because hey, what happens when you control the money? You can control a lot of different things, because Robinhood's looking to get into real estate, they're looking to get into banking, they're currently in crypto, and obviously investing. So they want you to put your cash there because the more cash you put in there, the more money they can make right here off of the interest. Now, I couldn't find anything online to say how much money they make on how much interest they make and where they put that money that's currently in there. Like when you deposit something, where does that money go? What's earning them the interest? They have to put it somewhere for it to earn the interest. I mean, is it U.S. Treasuries? Is it bond? I mean, what are they putting it in? So they're making money on that. And I guess the most controversial of them all is rebates from market makers and trading venues. And I think that's where, kind of the skimming comes from. Like people think that, they're making money from market makers, which they are, and trading venues, but this is nothing different than what other people are doing. I did pull up an article here from Bloomberg. It's saying, Robinhood was bringing in more than 40% of revenue earlier this year from selling its customers' orders to high-frequency trading firms or market makers, which they cited right in here to kind of line it up for you because it gets a little confusing, like Citadel Securities and Two Sigma Securities. According to three people, which is pretty vague, hey, those three people over there, with knowledge of the matter who asked not to be identified because the details are private. See, this is the thing, because everything is on under wraps and everything's private. When they become an IPO, it's gonna be interesting to see how they make money. Almost all retail brokerages employ the practice called payment for order flow, and it's an unlikely strategy for a company built on an anti-Wall Street message. So I think that Bloomberg here, this sentence is kind of irrelevant. It's an unlikely strategy for a company built on an anti-Wall Street message. At the end of the day, they want millennials to invest, and they're not. Robinhood is not necessarily anti-Wall Street. If they were anti-Wall Street, they would definitely be out of business ASAP. Which, I mean, they're we'll get into that later, but Vlad even put it on there. They did put how do we make money section of your website. I wanted to use this opportunity to shed some jargon, shed some light on how Robinhood execute orders. No jargon, only the facts. The letter said that the company did not take the size of market makers' payments into consideration when deciding where to direct trades. We send your orders to the market maker that's most likely to give you the best execution quality. Honestly, I don't necessarily believe that is true based on my use of Robinhood. But like I said, it's very one-sided, because what you do on Robinhood only you can see, and what they do on Robinhood, they can see what they see and what you do. So it's on the consumer end, it's not very transparent. You can select limit orders, but you can't decide what exchange you're going to go to, and you can't decide that like you can on other platforms. So, and then it says, for even finer control, we offer limit orders and stop limits, which allow you to name your own price. Well, thank you for that. Like he was giving investors something brand new. Like limit orders are given, and it doesn't matter what platform that you're trading on. I highly recommend that you trade limit orders. So they're getting almost half their revenue, 40% of the revenue comes from rebates from market makers or trading venues and routing. Basically, they're getting paid to route orders, and they say they select the best price and the best broker, but who knows really if that's true. So I definitely want Robinhood to become a public company, because I think that's going to make them a lot more accountable, and it's going to allow a lot more eyes on what they do and give some insight onto how they make money and who is involved. Because as you guys know, I think it was a few months ago or last year, they try to launch a their own checking and savings account. And this is kind of what kind of made people very suspicious when they released this. They said, hey, you're going to get 3% back on the money that you put in here. And people are like, wow, that's really great. That's really high. Checking and savings account with 3% interest. I mean, that's great. Sign me up. I'll put $200K in right now. But then the issue came back was it wasn't being FIDC insured and the SIPC, sorry, all these FDIC insured and the SIPC, all these names here, had serious concerns because they don't insure certain things. The SIPC, like it says here, protects brokerage accounts, which are meant for the purpose of investing in securities. Cash in those accounts that isn't being used to invest in stocks would likely not be protected. So if you have cash sitting there, the FDIC wasn't going to protect it, and the SIPC wasn't going to protect it. So who's going to protect the money? So that was the big issue. Is it wasn't a safe place to store your money. Where when you put it into a bank account, it's FDIC insured, you feel good. It's FDIC insured up to $250K, and you'll feel good. Like, okay, if there's a bank run or something's too big to fail or something, or the economy fails, the FDIC will give me my money back. I mean, that's the purpose. Or the bank fails. And then in here, they just kind of talk about, they'll do this responsible thing, but what was the, where was, okay, here it is. So the Stephen Harbeck, he said he didn't have a chance to air the issues out with Robinhood because they never called him or the SEC ahead of launch. So this was pretty important when I was looking into this a while ago. Is they didn't notify anyone. So they developed this product internally, and they're like, oh yeah, we're Silicon Valley, we're above Wall Street, we can do what we want. We're gonna launch this new product. It's gonna take Wall Street by storm, the banking by storm, and this is gonna be the most innovative thing we've done in a long time. But one of the things that caused me issue here is they didn't look ahead of any of the securities. They didn't call the SEC. They didn't call anybody to see, hey, is this okay to do? Anytime you launch a new financial product, you need to figure out. You need to see what you're under, what compliances you're under, what you're going to be held accountable to some sort of standard. What are those standards that you're held accountable? And they just wanted to get people's money and give them 3% and have a good time. Sounds pretty easy. So that whole thing, within a day, they then changed it to cash management. So they changed it from, so it was like within 24 hours they said, it's not actually a checking and savings account. This is a cash management tool, or I don't even, it's all it says here. It just says cash management on Robinhood. It has no other insight, and they're probably now they're going to be under the microscope hard before they even release anything. So they're I mean, I don't know what those guys are thinking, but if they're using those kind of practices in the investing world, and when you're investing stocks or trading in options, I mean, your confidence can't be that high. They probably most likely, if they're going to cut corners on a new product like that, they've cut corners in the past, and they're going to continue cutting corners until they get in trouble for it. And so far, they really haven't gotten caught on anything except for trying to launch this new product that flopped within 24 hours. And that's the way it goes sometimes. So I'm not going to let this video go too much longer. If you enjoyed the video, hit the like button. If you want to get more content, hit subscribe. Stay safe, stay green. It's always us versus herd.